Hello friends, I will discuss something called as normally insurance and insurance products today. What happens is normally today we find that normally life itself is uncertain. People live, but how long they live, that is rest assured. How long they can live happily, healthily and without any worries, anxieties, tensions, it cannot be predicted. So in such case what is required is now again to make sure that now again we are protected, to make sure that now again we as well as our assets, our dependents are protected from normally unforeseen risks. Okay, we go for a mechanism called as insurance. Insurance is normally a mechanism which saves or protects the assets from unforeseen risks. Any point in time normally there may be risk in the future. Any point in time there may be risk in individual life or for the asset. When the risk is for individual, ultimately the risks can be like this. There are risks of dying too early or risks of living too long. For an asset, normally early destruction of the asset or premature destruction is possible. So this itself is the risk. So in such case, normally one thing is inevitable, that there is an element of risk involved. So what do we do for protecting ourselves, human beings, human capital and our assets? We go for insurance. Okay, so insurance is normally a contract under Insurance Act 1938 between insurer and insured. Here, insurer refers to a company and insured is a person to whom insurance coverage is given. What happens here is, insurer promises that normally again he will take care of the risks, that is company promises to take care of the risk, and insured, that is the person, promises to pay the premiums on time. So like this the contract starts. Simply you can understand like this. See, the logic is like this. Insurer is the company. Company agrees that I will take care of the risks provided you pay me the premiums. And what insured, that is normally the person who wants the insurance, say that normally I will pay the premiums on time. So likewise a mutual agreement between the two parties takes place. On mutual agreements, what happens there is normally the contract starts. Once the contract starts, ultimately the day in which the policy is taken, insurance coverage starts for the person or assets. Okay, one part. Next, why we need insurance? What is the purpose of this insurance? Let us see that now. Okay, the major importance of this one or major purpose of taking an insurance is, we can put it like this, PIPS, PIPS in short, PIPS. What is this PIPS? P here stands for protection, I stands for investment, again P stands for pension and S stands for savings, PIPS in short. So what is this? Most of the time normally we may say that now again protection. Why the protection is required for us? Because any point in time if we meet with an accident and suppose if we cannot recover back from that particular accident, we face partial disability or unfortunately if there is a death, ultimately what happens is our death will not only affect us but our dependents or the family also. So in such case our family suffers because they lose a breadwinner. They suffer an income generating individual, or human capital or human assets we can term like this. So in such case protection is required for ourselves and for our dependents. Secondly, investment. Investment is a process where we park the funds for a future better returns. One part is it is just like normally investing today for better tomorrow. Today we save a little for a better tomorrow. So in such case investment is parking pi by pi for getting better returns tomorrow. It's not so. Why? Because let us put like this. So the rationale is, today we are earning well, today we are doing well in our profession, today we can find that our days are good, but as the person gets aging is one thing which normally a person cannot stop. So due to the increase in aging factor, normally what happens is person's income earning capacity will come down. When income earning capacity comes down, ultimately what happens is he will become dependent again. So in such case, one thing which protects you from not becoming dependent on others is your savings. So your savings and your investment, that's why people invest. One part is there. And then third thing is normally pension. So the pension is normally a particular sum or a certain sum accumulated normally out of a created corpus or a created fund. So pension is normally a regular income given to the person after the age of retirement. In this normally what we can do is, after a certain age, say we have crossed 55 plus or close to 60 years, we can choose an age of retirement. At the age of retirement, normally we are given two options here, either a large sum, whatever is accumulated for so many years in which we have paid the premium. For example, if we take, see, put like this, if you have taken a policy of 20 years after you are getting retired, so 20 years whatever the insurance coverage given plus 20 years, whatever accumulated bonus is there, principal amount plus bonus, all together will be given as a big once lump sum investment for you. Second option choice is normally you can get the regular pension on selected sum, normally month on month till the death of the person, that is there. So the option is left to the policyholder there. So pension is given, regular income after retirement is given. Now the fourth part is savings. So any point of time normally individual has to save. So it is, the rule is save 1/5 of your income, whichever is coming from salary or regular business income. 1/5 has to be saved every month. So if a person parks 1/5 of his amount, hard earned money, definitely what happens is the accumulation of savings is possible. Because of this accumulation of the savings, one thing, see that there are many benefits. One thing is you need not have to depend on someone in case of any emergency, or in case you are in requirement of money, or you are in requirement of funds anytime. So in such case, normally it avoids dependency. That's why people have to save. So these are the four important reasons why people purchase insurance. One thing. Next, what are the benefits of having insurance? First benefit is normally the risk coverage. Proper risk coverage is possible when you are insured, but make sure that it's a fair insurance. Insurance should not be normally compensating normally the huge losses and then normally getting a small coverage or choosing improper products. So in such case, make sure that normally you are purchasing a good insurance, a fair insurance almost. That is one side. So proper risk coverage is possible. Second thing is normally in any point in time, because of insurance, all of a sudden if there is a loss because of a death, because of partial disability, or because of some unforeseen events, individual or asset, normally it can be compensated for the loss. Insurance company will pay the compensation for whatever the amount insured. That is one side. So this benefit is there. And third thing is normally it's an asset wherein normally we can see that normally it is treated as investment. Fourthly, it provides benefit of income tax under section 80C of Income Tax Act 1961. Up to 1.5 lakhs invested can be claimed as deductions. It can be shown as savings and we can get tax benefit of same under section 80C. There is there. So these benefits are there as far as insurance is covered. Today, now let us see that normally again what is the present market for insurance in India. Presently, the market for insurance in India is normally again only 1/4 of the population is insured. So which means rest 3/4 or 75% of the population still requires insurance in one or the other form. So in such case, normally there is large market or potential market which is still untapped. Mainly the reason for this is normally lack of awareness, or people become negligent, people show some gross negligence somewhere, or sometimes we find that normally again people don't want to take insurance because normally they think that it is a regular cost for them without understanding normally its use and where normally the funds go, and then normally because of lack of education we can say. So in such case normally there is huge market still unpredictable in the case of Indian economies. Okay, that is there. So this is how now insurance market is. Okay, one part is. Now coming to the insurance products. Okay, basically there are two types of insurance which you have to discuss here. One is called as life insurance. Second one is called as non-life insurance. In the case of life insurance, normally the following products come into picture. First one is called as normally your annuity or pension funds. In the case of annuity or pension funds, this is for those people who want regular income after their retirement. To them, normally pension policy is very good. So any point in time, a regular income is expected after retirement, post-retirement. Once his service is over and when he is getting limited income, in such case, normally to maintain same standard of living, this product is good. Okay, this type of policy is good. Second one is called as children's policy. In the case of life insurance, children's policy is the one where there are two types of people. One is called as a proposer, second one is called as life assured. Proposer is the parent and life assured is the child. The policy is taken from 0 to 18 years here. A small child can also be insured, and the purpose of taking this is maybe to meet the higher education need, or maybe to meet future commitments like marriage, or if funds are required for normally the setting up of any business, or if the asset has to be made in the name of the child. If as a parent normally again, so the parents normally today take any responsibilities. There are no parents in this world who are going against responsibility when it comes to children. So ultimately what happens is normally again they want to again make some assets for the children. So this policy can also be an asset. So in such case, with this intention, children's policy is taken. This is there. And third one is normally called as traditional policy, a whole life, or normally the endowment policies. Whole life and endowment policies are very good normally as far as normally you go for a traditional plan when you want normally a guaranteed returns where you pay long term. Long term you make a payment, same amount of premium will come, but what happens there is normally see you are given an appropriate coverage plus year on year accumulated bonus. Today, as per the recent statistics, what is happening is no policy is normally giving bonus less than rupees 75 for every 1000 sum assured. So, just you can calculate how much it is when it comes to 1 lakh sum assured per year, how much it is when you come across 5 lakhs or 10 lakhs or 1 crore sum assured, whatever it is. So, in such case bonus rate is normally above 75 rupees for every 1000 sum assured. So, bonus rate is good, one part this you can understand. So, this one side. So, traditional policies are good for normally those people who want regular returns, guaranteed returns, one part. Next one is called as linked policies. Other name for this is called as unit linked insurance policies. In the case of unit linked insurance policies, whatever the investor invests, normally it is treated as normally the units, and these units normally fetch normally a value called as net asset value. Net asset value is normally it changes on daily basis. For a mutual fund, it is calculated as NAV equal to 1, NAV is equal to fund value into 1 minus exit load or 1 plus entry load. This says so. NAV fluctuates on daily basis. Okay, so the rate of NAV is dependent on performance of equity market. In equity market, normally if the funds perform very good, so in such case we find that normally the respective NAV value increases and the fund value of the investors will also increase. Investors will get a better rate of returns here. There is something called as lock-in period for this type of investments. Minimum is 3 years lock-in period. A lock-in period is normally a period where we can't touch the investments. What happens there is normally again, we have just see that normally see how the investment is parked, how it is performing, whether it's good, like that we can see. So, in such case normally the 3 years lock-in period minimum is given, and thereafter after the 3 years lock-in period is over, normally again there are 3 options: either completely withdraw or partially withdraw up to 90%, leave 10% there itself, and then third one is normally again not to withdraw, leaving it to grow, leaving the funds there itself to grow. But when this type of policy has got certain risks, first one is it is subject to market risks. Where market, now equity market, it is invested in equity markets. In equity markets normally there is a volatility. What is volatility? Change of price. Suddenly there is a fluctuation in the price. Share movements can again increase or decrease, volatile situation. So, in such case, any point time if the price decreases there, ultimately what happens is fund value will come down. Investor will not even get normally the invested amount also. So, there is huge risk of such type of investment. This is preferred by those people who are ready to invest for long term and who are ready to accept market risks. So, for such type of investors, this type of policy is suitable. So, this is something on unit linked insurance plans. Okay. Next type of plan is under non-life insurance, second type of plan, that is non-life insurance. Here we come across normally say basically motor, med claim, public liability and other insurances there. So, all these insurances are normally equally important for any human beings. Why? Because any point in time there is a risk in any human being's life. Risk can lead to loss of asset, loss of income, and it can also affect revenue whichever is coming on regular basis to the respective owner of this asset. Okay. To sum up, what I can say is insurance is very important for any human being. It is very important because of 4 reasons: pension, investment, protection and savings. Any point of if individual do this, normally he is in a better side of the life. If not, he can't maintain normal standard of living. Thank you very much.